Hello and welcome to another video on my YouTube channel. My name is Joris and today I'm going to talk about the 10 rules that I always keep in the back of my head when I'm deciding whether or not I want to invest in a stock or an ETF to do the long-term dividend investing thing. So first off, always go for quality before the dividend yield. So for quality companies, this doesn't mean that you need to go for aristocrats or kings. It's nice that you have the certainty that they already have a history of 25 or 50 years of consecutive growth, but in the end, it's not that relevant. Look at Disney. So, okay, they announced now that they are going to start paying a dividend again, but in the end, it really comes down to the business they are in and how they are performing and how they will perform in the future. So the rules for buying stocks is always, are always, you need to understand the company. The company has to have a durable advantage or a moat. You have to trust and like the management of the company. If you don't trust the company, just walk away. And you have to like the price. So yeah, the price, that's a topic for one of the future videos, I think. How you have to calculate the intrinsic value of a stock, of a company. But I'm not going to go into that today. But the PE ratio, I already stressed it in my video about 20 SMI stocks. The PE ratio is really important for me. It gives a first estimation, but then you still have to look at all the other things in their annual report. But as I said, that's for in a future video. Then for ETFs, you have to like the index where you are investing in. And for example, if you don't want to invest in banks, and then you are purchasing a ETF which invests for 48% in banks, so in financial sector, then I don't think you really looked at the ETF, and you should actually have done that and considered buying another ETF. Also, ETFs have fund managers, and you have to like them, and you also have to like the total expense ratio, which they charge. I'm going to mention it later on because it's that important. And then you have to go for full replicate or sampling ETFs before you should consider going for swap or synthetic ETFs. So, and then the worst kind of ETFs that I think that are around right now are the yield max ETFs, which are kind of synthetic covered call ETF. I really don't like it how those things operate. They yield a cash flow, that's for sure, but whether or not they are a yield trap or a dividend trap, that's another thing. One thing is for sure, as diff, I mentioned them before in some of my other videos. So the Global X Super Dividend UCITS ETF, US dollar distributing. It has a dividend yield of 12.5%, but if you look at the graph, it's nothing to write home about. So you start at 12.45, so in the beginning of May 22, and then now, yeah, yesterday evening, on Monday evening, it was at 7.87 on the SIX stock exchange. So that's a return of minus 36.8% in 1 year and 7 months. So if you have a high dividend yield and you look at the graph and it only goes down, there isn't a period that it really recovers even a bit, then yeah, it's a dividend yield trap. So don't invest your money in SDIF. Do not underestimate the effect of the dividend growth. That's my rule number 2. So if you know that the dividend grows, so you always know that your dividend yield on your initial investment is always going to grow as well. So, for example, if you receive 1 Swiss franc on a stock that costs 50 Swiss francs, then you have a dividend yield of 2%, but with an annual dividend growth of 7.2%, and with the rule of 72, then you know that after 10 years, your dividend has doubled to 2 Swiss francs of dividend. Then you know that your dividend yield is up to 4%. And 4% is really important. I will mention it later on in the video as well. So 4%, it's the 4% that I use for my 300 rule. And yeah, so you can go for a dividend growth stock if you have a long time period to go before you retire. And then you know for sure that the money you put in is going to bring you in the future 4%. So when you start off with a 0.5% of dividend yield and you want to go to 4% and it's a high dividend growth stock, you don't have a problem. But you shouldn't confuse dividend growth with growth stocks, because a chicken is a bird, but not all birds are chickens. So you can say that dividend stocks can be growth stocks, but a growth stock is not necessarily a dividend stock. And in the same regard, you can say that a dividend stock can be a dividend growth stock, but a dividend growth stock is always a dividend stock. So, rule number 3, you have to take into account the costs that you make when you are trading or buying stocks and ETFs. And the taxes matter as well. So, for the trading costs, you have two kind of costs that really matter. So the cost of buying the stocks. So you have the trading fees and the taxes on the market where you buy the stocks or the ETFs. And then you have also the custody fees. That's the cost of the actual account where you deposit your stocks or ETFs. And that can amount to quite a lot. So, for example, if you invest with a certain bank and they say every year we charge a 0.5% of what is on your account, you lose every year a 0.5% of what is on your account. On the contrary, when you have a bank that says we charge as much up till the point of 100 Swiss francs, then you will only lose 100 francs. And this means 100 francs with a 0.5%. That means that after you invested 20,000 or more, you have a fixed fee. So if you have a fixed fee, that's more appropriate to put your money there or your stocks there than in a bank that keeps augmenting the costs as you go, because they have a fixed rate of custody fee. So choose your broker or your bank to fit your needs, because of course when you don't have a lot of money and you can only invest 100 francs and it goes really slow, then a 0.5% or paying a 0.5% up to 20,000, it's going to take a long time before you reach the 20,000 francs. So you have to take into account whether or not going to another bank is really worth it. And then you also should look at the fact whether or not the broker is lending out your stocks or ETFs to other parties, because in much cases this is true. They are lending out your stocks even though you don't realize it. And those parties, they are selling your stock, so they are pushing actually the price of the stock down, or they are at least trying to. So when you're investing in a broker that is allowing that your stocks are being lent out, then you are actually hurting yourself as well. That's why I went to Swissquote, because there you really have to give permission to Swissquote to lend out your stocks, and you get a fee then. But for me, the fee isn't worth it. So lending out, for me, that's not an option. And the Giro and interactive brokers and stuff, they are cheaper than Swissquote, but they are lending out your stock as well. So that's also really important. And then, of course, you have to use legal accounts to reduce your taxes. So first, try to fulfill your 3A pillar. That's a lot of money. So more than 14,000 Swiss francs when you're with two in the family that can do that. And that means that you need to be able to save more than 1,000 and francs in the month towards your 3A pillar. So that's already a big chunk that goes away. And then what is the tax on the dividends in the country the company ETF is from? And then it's really important whether or not you know if you are double taxed or not. So, for example, people from America buying Swiss stocks, they are paying 35% Swiss taxes on it, and then they still have to pay taxes in America as well. So that takes away a big chunk of what they can earn on the dividends. So it's really an important thing to look at, and in Europe as well. So here in Switzerland, you can buy stocks from everywhere, even from USA. And when you buy a stock in the USA, you are paying, you are withheld 30%. And then when you report everything correctly, 15% is always for America, and the other 15% you get back, you can get back, but then still you have to pay income tax on the amount that you received. So on the 85% that is left, you have to pay income tax in Switzerland. So that's also double taxed. And then, of course, one of the big killers, you need to diversify. Putting all your eggs in one basket is really a stupid thing to do. So I like the fact that ETFs have a built-in diversification, but as I said before, you have to know and understand the index. And if you invest in multiple ETFs, also look at the possible overlap in the ETFs. Because some people buy two ETFs, but in fact, one ETF is 80% the same as the other one. So you are in fact better off investing just in one ETF, because the other one is actually completely the same. So why would you spread your things out, except of course when they pay out in different months, and you want to spread out your dividend payments over the year, which is a good reason to do it. But if you don't look at that, and you are only looking in, it's a good ETF and that's a good ETF, and you are just blindly buying into it, and they have a huge overlap, then you are not doing it correctly. And then you need to do KISS. I don't know whether or not you know this principle, the KISS principle. So it actually means keep it stupid simple, or keep it simple stupid. But I don't like it when there is stupid in the sentence. So I always say keep it simple smarty, and you need to diversify. So rule number 4, diversify, but you have to keep it simple. So do not overcomplicate the things. So go for 10 up to 20 stocks at max and 5 up to 10 ETFs at max. Because otherwise you're really overcomplicating things, and that's not good for anybody, not for you and not for your partner, because they don't understand everything what you're doing. So yeah. Or you can do a combination. So the core satellite strategy, my wife and I, we are doing that. So the core means 60 or 80% are in 3 to 5 ETFs. I wouldn't recommend putting in stocks there, but that's up to your own liking. But I wouldn't go further than 1 or 2 stocks in your core. And then the satellites, 20 up to 40%, and it can be 4 to 8 ETFs, but in total, not more than 10. Remember that. And or 4 up to 10 stocks can be your satellite. And this means that the ETFs, they can go more or less around 5%, and the stocks up to 4% if you want to. And just remember, size matters. So if your portfolio is getting bigger and bigger and bigger, it's also normal that you will go into more positions, because, yeah, when you have a portfolio of 50,000 Swiss francs and you have 10 positions, and you go up to 500,000 and you still have the same 10 positions, that means that there is a lot of money in one of those positions. So in percentage, it's still the same, but it can be that you are not comfortable with that. For me, it doesn't matter. Whether or not I have 50,000 or 100,000, I will still keep to my distribution that I set it in advance. So I will not go over my 10 ETFs. But if it's not to your liking, it can be that you can go to 12 or 15 ETFs, and that you can go up to 25, 30 stocks. But too much is too much. Just remember that. And rule number 6, always remember that the stock market is not efficient and that you can take advantage of it. So sometimes they are undervalued, and then you can pick up stocks or ETFs with a higher than normal dividend yield. So when you have a ETF and normally it gives around 3.8%, and suddenly the market is going crazy and everything drops 10-20%, the dividends are still going to be the same because the companies didn't change. It's only the psychology on the markets that changed. And then you can pick up the same ETF at discounted prices, and then suddenly you can pick it up with a dividend yield of 4.5, 4.8% instead of 3.8%. So market psychology, it is a bitch, but if you know it, you have to embrace it, and you have to try to take advantage of it. It's not always simple. I will come to that later as well. But if you think the market is undervalued and you have your emergency fund, then you can consider using a part of it, not all of it, of course, so around 10-20%, and invest in the stock market on the moment that you think that it's really undervalued. But remember, it can cause a stress because you don't know whether or not you are buying already on the lowest point or if it is going to drop even lower. You don't know that for sure. And on the other hand, you're also reducing your emergency fund. So it adds stress in both ways. So keep that in mind when you decide to go for it. And another crazy, annoying sentence that you always hear is, do not catch a falling knife. And I always put behind it, unless you know that you won't cut yourself. And that's a really difficult thing, because unless you know that you won't cut yourself, that means that you really know the company, that you understand its business, that you know all the numbers, that you more or less understand that the market psychology is just going crazy and the underlying value of the company is actually not heard at all, that the management is reporting everything truthfully. So yeah, it's a difficult thing, but sometimes you have to go for it. And as I mentioned, yeah, there is only CCA. And I really don't like the term DCA, dollar cost averaging. But for me, there is only CCA, or consistent cost averaging. And that's why I say, yeah, market psychology, it is a bitch. Because when you can only save 100, 200, 300 Swiss francs in a month, like my wife and I, all those past years, yeah, you only have, after you receive your wage, you have 300 Swiss francs available, and you can invest it. But on that moment, when the market is picking up again, you are too late. Or yeah, on the moment that you invested your money, and 2 weeks later the market is going crazy and everything starts to drop, yeah, you don't have the money, so you can't invest anything. So you don't need to stress about that too much. You only need to worry about consistent cost averaging, and all those other videos where you see all the people investing 5, 10, $50 every week, or $100 every week. If you can't do that yourself, you only have to look at yourself and say to yourself, okay, I'm just being consistent and I'm always doing the same thing. So that's the main thing. Stay consistent in your contributions. So don't stress too much about rule number 6 when your wage and your savings don't allow it. So budgeting and saving are so important, and it's so underrated. Not a lot of YouTubers stress that too much. They are bragging about putting in every week 1,000 francs, or thousand of dollars into the stock market, and saying how much they bring in dividends already. It's really, really difficult to save money, especially here in Switzerland. So just go, every time when they say DCA, you say CCA. And then the other videos that you see with lump sum investing compared to dollar cost averaging, just always keep in the back of your mind that lump sum investing is a luxury problem. So when you start, it's a smart thing to do, because you need to pay the custody fees and stuff. If you have a broker that charges custody fees, that is, of course. And when you do the lump sum investing thing, in the beginning, you can profit from the fact that your dividends will pay for those custody fees, and you can just continue contributing, investing always your complete contributions. But if you are CCAing from the beginning, you always have to keep in mind to keep the custody fee that is going to be deducted from your account every quarter, to keep that amount available on your account. So don't forget about that. And yeah, lump sum investing, luxury problem. And if you receive a lot of money, should you go for DCA or lump sum? It's lump sum all the way. Most of the time, that's the best way to go, and you get the snowball rolling as fast as possible. And then the payout ratio and the total expense ratio. So I mentioned them before when I talked about the costs. So the payout ratio, or the payout ratio is of course for the stocks, and that's a metric besides the PE ratio to decide whether or not a stock is really a good dividend investment stock. So you have to pay attention to it because it stands for the safety of the dividend in the future. So if it's above 60%, and certainly when it's above 80%, you need to know why it is that high. So for example, companies that are investing in real estate, they need to pay out at least 90% of their profits. So there it is normal. But in with other stocks, it's not always that easy to know why it is that high. And when normally it was around 50-60% and suddenly it goes up to 95-98%, then that's a sign on the wall that they will not be able to continue paying such high dividends as they are doing now. And then the total expense ratio, that's more to do with the costs for ETFs. So if you can choose between two similar ETFs, so which invest in the same index and have the same investment strategy in that index, you always should go for the cheaper ETF with the lowest total expense ratio. And then rule number 9, compounding is key. So you have to turn your snowball into an avalanche, and you do that by reinvesting your dividends. That's why I always say that quarterly paying dividends stocks are better than annual paying dividend stocks. And that's why I also don't understand why in Switzerland, from the SMI companies, none of them are paying quarterly. I think that's really a pity because, yeah, it's it's not that attractive to have to wait for a whole year to receive a dividend. And Albert Einstein already knew it. He said that compound interest is the eighth wonder of the world. He who understands it earns it, and he who doesn't pays it. And in that regard, you should pay off your debts. That's one of the first things you should do, and that is pay off your debts. But I put it here, and it's really important that you do that as well. So accept those debts that let you pay less taxes. So when you buy a house and you have a mortgage, the mortgage most of the time you can have tax advantages there. So that's not really important. But if you have debts on your credit card that that starts ticking in the wrong way, then the snowball, because yeah, I think 5 years ago it was 14-15%, and now it goes up to 18-19% of interest that you have to pay on your credit card debt. So it's really important that you keep those debts as low as possible, and even try to avoid them. And another thing is, you have to reinvest your dividends. Everybody is saying that, but don't forget that at one time you will decide to start living off your dividends. So then you will not reinvest your dividends, and you won't put in any money into the stock market as well. So when you finally retire, you have to live off the portfolio that you build up during your whole investing career. And that's also an important thing. So investing 300 Swiss francs in a month gives more or less after 8 years. It can be faster, it can be even slower when the stock markets aren't performing as well as they used to. And in the past 4 or 5 years, it wasn't that great. So from 2008 up to 2018, it was rather okay, but from 2018 up till now, the rise wasn't that big. But after those years, you start receiving 300 Swiss francs a month in dividends. So you can then start doubling your amount that you put in your portfolio every month compared to the beginning. Of course, it starts slowly, 1 franc, then 2 francs, 3 francs, 5 francs. So it goes really slowly in the beginning, but after the moment you start to receive 200, 250, 10, 300 Swiss francs in the month in dividends, your snowball really starts growing, and a lot of people stop with dividend investing around 4 or 5 years in because they say it doesn't bring a lot, but you have to stay consistent. So CCA. And then the last one, it's fire is not a target. Generational wealth is. So you hear a lot about fire, so financial independence, retire early. It's a movement in America, it's starting here in Europe as well, but it should not be the goal. At least for my wife and I, that's not the goal. First off, we like working, but the goal should be to save, try to save, and invest and grow your dividend income to a certain level. So that level you should keep in mind, put it somewhere, and even track it. So we are above 5% right now of what we want to reach, and you still need to be able to live comfortably as well during the time that you are working up to the moment that you are retiring. So when I see YouTube videos or I read reports of people that reached fire, they always say that they had a savings rate of 70-80%. I don't know how that is possible when you need to pay 25 up to 35% taxes on your money that you earn. And if it's after taxes, they should explicitly say it in the video or at least write it as well. And I don't think that you are really living comfortably then. You are always trying to save as much as possible. It yeah, you still need to live. So don't forget that. And also the Trinity study, if you look at it, it's a really great study. It's not wrong at all. So it's scientifically correct. So 98% of the times it really works that when you have 1 million and you want to withdraw 40,000 every year, so the 4% withdrawal rate that they set is the optimal withdrawal rate for retiring, and you can live off 40,000 then every year, you will be able to live for 35 years in your retirement with 1 million invested at the moment of starting and then withdrawing 40,000 every year. So that's correct. But it involves selling 4% or selling the 40,000 every year. So you are in fact reducing the amount of stocks that you have on the stock market or reducing the amount of ETFs that you have on the stock market. And for me, that just doesn't fit what I'm aiming for. So I'm going for the 4% rule of 300. So the rule of 300. So I want to receive 1 Swiss francs when I retire from every 300 Swiss franc that I invested. So every 300 Swiss francs that I invested needs to bring at least 4% on the moment that I retire. and then I can keep my stocks for the rest of my life, and I can even give it to my daughters and say, here, for the rest of your life, that will give you that amount of money and you don't need to worry. But if you look at it, for me it's 4%, and for the Trinity study, for the people that want to do it on the Trinity study way, reaching fire, it's always 4%, so it always comes back the 4%, so that's really key. And with that, I want to conclude the video. It was again a rather long video, but not as long, luckily, as the previous one, so 35 minutes, more or less. I hope you liked it. I made it for my daughters, so later on when they look at this video, that they pick up the most important things that I always keep in mind when I'm investing the money that we are saving. So thank you for watching, and please consider subscribing to this channel. I'm up to 6 subscribers now, so thank you for the person that subscribed earlier this week, and see you on the next video. Bye.